Welcome to What and Where to Invest 2022. The show must go on. Whilst uncertainties and disruptions may still linger in the world, at fsm1.com, we believe that investing is for the long term. It's not about timing the market, it's about time in the market that investors should pay attention to. In the next segment, joining us in this panel discussion to kick off investing in our homeland Singapore are Lai Yu Huan, Senior Portfolio Manager from Nickel Asset Management, Adrian Chew, Vice President, Sales and Product Strategy, CSOP Asset Management, Yo Hui Shi, Equity Analyst, Stocks and ETFs Research from IFA Singapore, and Cyrus Ng, Analyst, Macro Research from IFA Singapore. They will be sharing about the bright spots of opportunities for Singapore and how investors can generate a long-term and sustainable stream of income, especially in uncertain times with local banks and S-REITs.
From the break, we have three speakers today, Yu Huan, Adrian, and Hui Shi, who will be sharing their insights on something closer to home, Singaporean equities. Thank you to our speakers for joining today. To start off, let's start with Hui Shi. The STI index climbed about 10% in 2021. What do you make of this performance, and was it in line with your expectations at the start of the year?
So the STI's performance in 2021 largely came in line with my expectations. The economic rebound has driven a recovery in corporate earnings, and in particular, the three Singapore banks, which are DBS, OCBC, and UOB, who make up about 40% of the STI, all did very well. So despite the low interest rate environment, they still managed to generate positive and strong earnings growth on the back of the easing loan provisions.
Yu Huan, do you have any thoughts on what she said?
Yeah, we agree that largely it was in line with our expectations. Markets were driven, of course, by the reopening, and the first half of the year really played out in that theme. Perhaps maybe what we did not anticipate as well was maybe in the second half of the year, the reopening, especially in Singapore, was maybe not as smooth as anticipated. And also in, let's say, amidst the manufacturing boom that happened, we also perhaps didn't anticipate the bottlenecks that occurred in the supply chain. But by and large, actually, the recovery in the economy and the market was within our expectations.
Thank you. Adrian, were they in line with your expectations?
Yes. So I would say the total return for the STI came in about 13.55% in 2021, right? Mainly driven by the banks amidst the macro recovery, expectation of interest rates hikes, which benefit from the bank's net interest margin. So, like just to echo Hui Shi, is that the STI has about 44% in terms of banks, right, which rose about 22% for last year. Top performer was DBS, which came in about 31%. On the flip side, Singapore REITs holds about 14% of the STI, gained about 3% return for last year, right? And it benefited from the reopening of the economy. And the index as a whole, is within our expectation. But for Singapore REITs, due to the Omicron late last year, sort of like affected the performance of S-REITs and a little bit fell short of our expectations.
Okay, thank you.
Yep.
You mentioned the Omicron as something that happened late in 2021. And in 2021, we saw the COVID-19 situation take multiple twists and turns. Mm-hmm. So do you think we will finally be past this pandemic this year? And if so, which companies and sectors do you think stand to benefit more from this transition?
Understood. So, it's a good question about the key concern is still the virus, right? And it's very hard to predict what COVID-19 will bring or the mutation will bring in the year 2022, right? And, globally, about 59% is vaccinated. This, on the flip side, means that 40% of the global population is unvaccinated. And that, gives more opportunity for the virus to mutate. And France just announced earlier this week that there's a new mutation, right? Mm-hmm. And according to Goldman Sachs research, they expect and they predict a large-scale viral infection in the first quarter of this year, and you could see that coming through with US reporting 1 million new cases a day just earlier this week. So that's the uncertainty that the virus might bring. On the flip side, on the local side, Prime Minister message, the New Year's message, saying that year 2022 is going to be a year of transition, right? It's going to be a continued battle with the virus. However, we believe that the reopening of the economy, the story, remain intact. And having said that, industrials, like which sector? I would say that REITs that include warehouse, logistics, data center REITs should continue to benefit from the structural tailwinds, pandemic or not, right? Office REITs definitely have a lower downside risk, delayed by supply and demand kind of from the new firms. In terms of retail REITs, right, suburban malls were definitely anticipated to be more resilient versus those malls along Orchard Roads due to the lack of tourists at this moment. Yeah.
Okay, thank you very much. Moving on to the economy, for Hui Shi, we saw rising inflation this year, and the Fed is likely hiking rates soon. And there's also talk that the MAS may tighten this year. So, which sectors do you think can benefit from this global monetary tightening?
I think a sector that could benefit from this monetary policy tightening will be the local banks, because the main interest rate benchmark for the Sing dollar financial markets, which is the Singapore Overnight Rate Average, also known as the SORA, generally tracks the US federal funds rate. And the net interest margins across the banks were flattish over the past year as SORA was at low levels. And so when the Fed starts to hike rates later this year, I believe that SORA will also likely increase, and this will help to expand the net interest margins of the three local banks. And given that about 50% of their revenue comes from net interest income, these rate hikes would benefit the earnings of the banks as well.
Thank you. Yu Huan, do you agree that you
Yes, I do. And I mean, along the same vein, you find industries like, let's say, for example, insurance will usually benefit when interest rates rise because their liabilities are longer dated than their assets. But aside from that, also very traditional beneficiaries of inflation, like the industrials, because they will benefit from, let's say, the commodity cycle that's strong right now. Those are also sectors that we can look forward to that will benefit from an inflationary environment.
Okay, thank you. Adrian, what are your thoughts?
I would have to agree with both of the speakers.
Okay, sure.
Yes.
So both financials and industrials.
Yep.
In addition to monetary policy, let's talk about fiscal policy instead. There's a strong possibility of a GST hike in the upcoming budget. So Yu Huan, how would this GST hike affect your stock picks?
Yeah, so I mean, a fiscal tightening GST hike normally would be negative for the markets, negative for the economy. So for us at Nikko, we are very much bottom-up stock pickers. So we go back to what we do normally, which is to pick stocks based on positive fundamental change and also sustainable returns. So this is what we will still focus on. Amid such an environment, we will be looking for companies which have strong business models, strong franchises that are able to pass on some of these increases in taxes, for example, to the customers. So we'll be looking for companies which are, for example, in the new Singapore thematic that we favor. These are companies operating in industries which are representative of the future of Singapore. Within these names are in industries like data, tech, renewable energy, for example. So lastly, we could also look for companies which have corporate restructuring angles. So within such a challenging environment that usually is brought forward by fiscal tightening, we will look for more bottom-up ideas with companies which are high quality companies that will ride through this environment.
Thank you very much for your thoughts. So moving on to on a sector level analysis, Hui Shi, financials are a key sector of the STI and it includes our three major local banks. So do you think the financial sector as a whole in 2022 can perform well? And which banks do you think can outperform the others?
So for the financial sector in the STI, it mainly consists of 4 different stocks, which will be the banks as well as the Singapore Exchange, SGX. But within this sector, I prefer the banks more because I think there are a lot of developments that could happen this year that could benefit them and which in turn can help to drive an outperformance. So firstly, like I mentioned earlier, rate hikes will definitely benefit those banks as this will help to expand their net interest margins. And besides this, I think another development to look out for this year will be loan growth. So loan growth, we believe it will continue in 2022, mainly being derived from the more resilient manufacturing sector, as well as the recovery of the property-related sectors such as construction, following the gradual reopening of the economy. And lastly, another factor would be fee income, especially wealth management fees. That would be a key earnings driver for the banks moving forward. So the three local banks, they are in a good position to capitalize on the fast-growing wealth management space in Asia, which is being supported by rising income levels from the wealthy middle class. And besides this, card fees, which has benefited from the economic rebound last year, is likely to continue on its uptrend this year as well. And so overall, the banks, they still remain well capitalized. So this reaffirms their positions to maintain sustainable dividend payouts. And I think on average, in 2022, investors can expect a dividend yield of about 5% from the banks. And in terms of valuations, I think that OCBC and UOB, they would be more attractive for investors given that they have more room for capital appreciation.
Yuhuan, do you agree?
Yes, I agree that banks will do very well. In general, in a rising interest rate environment, the Singapore banks all benefit from having higher net interest margins. I'd like to highlight, though, of course, there are other factors. For example, like let's say DBS, for example, it's the most liquid bank. So in an environment where liquidity is scarce, the most liquid bank usually does very well. Apart from that, we also pay a lot of attention to another factor, which is the digital capabilities of the bank. So we think that digitalization will be a very important thing to look out for when selecting banks, because that would not only allow them to avail themselves of different business opportunities, but also allow them on the back end to save a lot on costs. So obviously we think that a name like DBS has a very strong digital capability. And so that these are some of the factors which we believe will be important for stock selection in the financial sector.
Thank you very much for your insights. Moving on to another key sector of the STI, which is REITs. So, Hui Shi, among the different property names, which do you think can perform best in 2022, both in terms of capital appreciation as well as dividend yield?
In terms of both capital appreciation and dividend yield, I think that the industrial and the data center REITs, they could perform the best in 2022. For REITs, capital appreciation usually comes when there are expectations of an increase in their distribution per unit, also known as their DPU. And I expect the DPU recovery of the retail REITs, especially those that are focused on the Orchard Road malls, to be very gradual, especially if we take into account the near-term risk from Omicron. And on the other hand, to echo what Adrian mentioned earlier, even if there's a pandemic or not, there will be strong structural drivers driving the DPU growth of the industrial as well as the data center REITs. So, for example, the acceleration of e-commerce and also the shift from just-in-time to just-in-case inventory management in order to cope with the supply chain disruptions caused by the pandemic is expected to drive the demand for warehouses. And the pandemic has also accelerated several long-term trends which drive data traffic, and that in turn leads to a greater demand for data centers. So such trends will include increase in spending on cloud services, your emerging technologies, artificial intelligence, Internet of Things and 5G, as well as the growth of internet platforms. So I think that these trends, they make the industrial as well as the data center REITs very attractive, providing them with the potential for capital appreciation. And now in terms of the dividend yield, I believe most of the large cap industrial REITs like Ascendas, it is offering a yield of about 5% in 2022, and that is still considered quite decent as that is around the sector average. On the other hand, for data centers, the yield is slightly lower at about 4%. But that being said, there could be more room for further yield compression given that data centers are seeing robust demand post-pandemic. So in terms of total returns, I think these REITs could do well in 2022.
Adrian, do you agree on her stance on retail and industrial REITs?
Yes, I totally have to thank Hui Shi for backing me up in the sense that we prefer to look at a total return kind of criteria rather than just looking at the yield, because yield is just part of the investment story, right? High dividend yield stocks means that either the price has been stable or depressed. That's the reason why it explains a higher dividend yield, right? So we look at the capital appreciation and the yield as a total return kind of totality in terms of when it comes to investments, right? And the CSOP S-REITs Leaders ETF offers, a very well diversified portfolios of, large and mid-cap S-REITs, right? Or that's listed on SGX, or we call it Singapore REITs, right? To give investors, very stable long-term total returns, right? So in the last 5 years, the S-REITs Leaders Index has garnered a total return of about average 10% per annum, right? And what makes this leader very unique is because of the liquidity adjustment kind of strategies. There's 42 names in S-REITs listed on SGX. We get in the big boys into the club. And who plays in what positions is actually based on the liquidity for the last 6 months. And for the last rebalancing in September, we've seen there is a huge uptick in terms of retail REITs, and after rebalancing, that has actually put up more weight into our index and into our ETF. Now, what this liquidity adjustment does is actually it tracks fund flows, it tracks investors' interest into the particular sectors. This helps the index and the ETF to be more robust in terms of tracking, to be more relevant to the current economic situation. And having said that, our index Leaders Index ETF right now comprises about 50% weightage and exposure into the new economy sector, such as industrial, logistics, and data center. And so this is actually our preferred sector due to the strong tailwinds of e-commerce going forward. And we also like office REITs as a whole because they would definitely likely fare better in this year, 2022. As Singapore shift away from the full default 100% working from home, opening up a bit by letting 50% of the workforce coming back to office. And then we believe that eventually they will come back to 100% setup, return office setup. So again, office REITs comprises about 23% of the Leaders Index in this case.
Okay.
Yep.
Overall, it seems you're pretty optimistic on SG REITs. So I guess if you could summarize what you mentioned just now about your ETF, could you perhaps summarize in a few sentences why you recommend this ETF?
Yes. So again, this S-REITs index, right, is actually based on the large cap. We get into the large and mid cap S-REITs on SGX to be in the club. We rebalance it not on the traditional kind of market weight kind of weighting. Market cap kind of weighting, we weight based on the liquidity for the last 6 months. So if for example, a REIT has been actively traded for the last 6 months, this reflects investors' fund flows. And then so during our rebalancing at every 6 months interval, we would actually put in more weight to this particular REITs. This is just to signify, just to rebalance the portfolio to signify a particular sector that is actually very hot at the moment. So it keeps the index and ETF very robust and very up to date to the current market situation. Okay. So again, after 2 rebalancing, right now 50% is actually into industrial, logistics, warehouse, and data centers. So let us do the rebalancing for the investors right now.
All right, thank you. Moving on to Yu Huan. One of our recommendations today is the Nikko AM Singapore Dividend Equity Fund. So why would you recommend this fund for investors?
I think for investors who are looking to invest in our home market, Singapore, they really do have to consider a dividend fund because Singapore is a fairly mature market. It's got a lot of high quality companies, strong dividend payers. So having a dividend strategy makes a lot of sense, right? And also the fund itself, I'll talk more in my presentation, but the fund itself is designed to offer the best total return proposition by focusing both on dividend anchors as well as dividend growers. And we think that combination of dividend anchors, which are strong dividend payers, plus a little bit of growth, is really a very good package that will give investors a strong overall return for the investments.
Okay, thank you. We look forward to hearing more about your fund later. But just to sum up today, perhaps we could start with Adrian today. How will you rate Singaporean equities as a whole in 2022 compared to both ASEAN and global equities?
Well, I think maybe Yu Huan is actually better. But I would say that, based on the STI right now, right, it's actually 40% into the large banks and 14% into the REITs, which are these are actually both like we once said, it offers growth in terms of the bank portion, and the REIT side is actually very stable, and yet also offers investors income. So I would say comparing Singapore equities to the ASEAN equities, I think that we actually will categorize Singapore equities as a safe haven. Right.
All right. Yu Huan, what are your thoughts?
I think Singapore will do well because Singapore is traditionally a market that does well when interest rates rise because of the banks, let's say, for example. And then traditionally, you will look at some of the other ASEAN countries, perhaps like Indonesia, where in a rising interest rate environment, usually it is a little bit more challenged. Of course, the rising tide of the reopening will lift all boats. But I think Singapore is very well placed, both in terms of the interest rate cycle, as well as being the center of ASEAN, where it's also doing a lot of business with the rest of the economies. And if they do well, we will also do well.
Thank you very much to our speakers today, Yu Huan, Adrian, and Hui Shi, for joining us today and sharing your views on Singaporean equities.